All right, good evening, everyone. Good evening. Thank you for coming out tonight. Appreciate it very much. And welcome to our second meeting of the Michigan Investor Group, our MIG. We're fortunate tonight to have a super company and super presenter, and I'm very grateful that John and the Promanas team have come out to join us, and very grateful for that. Don't mean to have the segregation in the crowd here. Maybe Dave and Mike and Brent will sit on this side too. So our agenda tonight, just a couple things. I'd like to go over a couple housekeeping items, and then we're going to have John's presentation or discussion talk. Then we'll have a little Q&A time, and then if you haven't already, there'll be a chance to meet the Promanas team afterwards, and there's a sign-up list back there if you want to fill in your name and email, and I'll get that to Promanas if you want to hear more information. So in July, we had our first meeting. Dave Zook was our presenter, and he said he heard from a couple MIG members, and then I believe there's been two people who have made investments in some things that Dave talked about. So that's kind of interesting. I think he was glad about that. We have a couple future meetings planned. Don't hold me totally to the fire, but October we should have a presentation titled Anatomy of a Real Estate Deal. It'll be a little more in the details about real estate metrics, real estate numbers, real estate values and that kind of thing. Then in November, we're going to have a mobile home park night. We're going to have a man come who actually buys and turns around parks. And I think I might actually speak a little bit too about the spectrum of mobile home park funds that are available out there to invest in. January, we're going to talk about life settlements, so that'll be unique. And then in February, we have an overview of alternative investments and a kind of an interesting speaker. So those are what we got on the docket for the next few months. So tonight we have Promanas, and very, very briefly, Promanas is a privately held commercial real estate investment firm, and they focus on raising money from individual investors and then going out and deploying the capital. And John will tell us a lot more about that. I was introduced to Promanas by another member of MIG, Dr. Mark Zandy, and it's always good to have a reference to get started. And I did a little bit of research, learned they were investing in Denver, had some broker friends in Denver who I got thumbs up from, and then a friend of mine actually manages a company that cleans buildings for Promanas. Got a positive impression from him, and then we decided to invest after meeting John and learning more. That's how this kind of came to be. I'll let John tell you more about himself and his background, but I would like to mention the flyer on your tables. There's some recent news that John got selected to a prestigious group, and that's kind of neat to hear about. So thank you, and John, please come on up.
So, I was born in 1970, which if you're really quick makes me 48 years old, which means a couple things. One, we have to start printing larger on the cards. I can't read this stuff. And two, my experience is limited to just about the past 40 years. The first deal I ever did was 40 years ago. I was 8 years old. And it's an interesting deal because it's actually indicative of the exact same thing that we do today. I was goofing around with some neighborhood buddies, and it was a hot day, summer of '77, I think. I lived in Ann Arbor near the corner of Nixon and Blewett. So if you're old enough, you know the relevance of those two street names next to each other. Nixon and Blewett. And but so it's actually I've told this story a number of times, but it's funny how we remember things, right? Like I don't know if I came up with the idea or my surrogate big brothers next door came up with the idea, but one way or another, we got the bright idea to go and take my red wagon down to the A&P grocery store and buy a bunch of Big K cola and Big K pop, which was 17 cents a can at the time. And we got some ice. And I had to borrow some money to do that from my parents because I didn't have any money. So I probably borrowed $10 from my parents, bought whatever I could buy. And then we dragged it over to the Leslie Park Golf Course, which was maybe a half mile to a mile away. And we went to the furthest point on the golf course on a hot summer day, and we sold cans of pop to golfers for 50 cents a can, which back then was probably way more than you would charge for a can of pop. But I was like this. I actually had hair. I was blonde and had a cute little 8-year-old guy. So we'd sell out all the pop. I'd return the money to my parents. I can't honestly say I gave them extra money back, but I'd like to think I did. And then, we'd drink a few sodas ourselves, and we'd go back to the grocery store and buy 10 cans of whipped cream, and then proceed to, dump it all over ourselves and eat too much whipped cream and get sick. So but the idea of that, the syndication process is exactly the same. And over the years, it's evolved. I tried different things throughout life, like mowing lawns, service type business. I tried some sales type jobs and various things. And the idea was always to try and create more value for somebody than it cost to have me involved. So being an employee for someone never really worked for me for a number of reasons. One, I was just too ADD and I just couldn't really focus, and I couldn't figure out how to fill an 8-hour day when most of the stuff required today takes really 2 hours, and then the rest of the time you're kind of filling time. So I just was never really employable. And I'm sharing this with you for two reasons. There may be two components here, and I'm not really sure. One is, do you want to do things like we do? That's kind of, I've spoken to people about that, and we've talked about that. Or do you want to learn about, what a good deal is or isn't in terms of how people put things together? So the history about who I am, where I came from, what I do, and this idea of trying to create value for people is an important component to look for in anybody that you're investing with. And so, the first thing people ask me, well, how do I know, where do I find deals? Where do I find ways to get involved? And so, not necessarily involved, but where do I find opportunities? And how do I make sure they're good opportunities and it's a good person? Well, one, you'd have to look at character, like what motivates them. Why are they doing it? Why is David Zook going to fly here, spend his time, other than, for making money? Because that's really, I don't need the money. I did, but now that's not really the passion or motivation behind it. There has to be something else. For me, very personally, if I really were to dig deep under the layers and be truthful, it probably has a lot to do with ego and trying to prove myself still. Because when I was a kid, I didn't really get good grades. I was terrible in school. I got, the teachers all said stuff like, this kid will never amount to anything. At least that's what I heard. And so for a long time, it was about trying to prove I can do this. I can take someone's money. I can invest it. I can see a project through. I can see it finalized and I can give them back more. I can beat projections. And that gives me a sense of validation. Now it's more a sense of embarrassment, to be honest with you, when this Forbes thing came out and it, Lisa posts this stuff on Facebook and everybody stops me. Oh, congratulations. It's actually just more like, I didn't realize I was an introvert. But it turns out I am. So I landed after college I'm going to skip through the college part entirely and the businesses that I tried to run there. I landed on real estate, and it was really, it just made sense to me. I'm not going to be able to answer a lot of questions that have to do with other asset classes and other things. I've looked into all of them. I've tried them. I've tried everything. I'm an experiential learner. I'm vocational, and I just haven't done well with anything else. And for some reason, real estate just is. It's easy for me to get. It's bricks and mortar. It's it's a finite downside in most cases. So I will be happy to answer any of that. We're approaching, I was trying to add it up today in terms of resume scenarios, but I think I'm approaching about $1 billion in real estate transactions that I've either brokered or done personally. Mostly we've done them personally. I was a broker for a number of years before I started basically just doing the whole private equity thing and abandoning brokerage. Right now we own and operate about a $200 or so million portfolio of existing real estate, buildings just like this one, office buildings, medical buildings. Actually, it's probably around 250 million or 230 million, but it's about to be 200 million after Monday because we're selling a big building, which is great. And we have 9 active developments right now in process, ground up developments. So I could speak to that if you had questions about that. These are projects in Denver, Nashville, Florida, and Ann Arbor, which total around 350 million in real estate that we're currently constructing from the ground up, which I wouldn't have advocated just 5 years ago, but in the last 2 to 3 years, it's certainly proven to be the best place to get into real estate investing, in my opinion. I think we were out in front of that curve because we started it about 3 years ago when you could really see the economic dynamics of the market changing drastically. And I don't know where all of you live and if you see this, but the easiest way to monitor these things is by looking at single-family home prices and sales and inventory, and that's a great barometer of what is to come in real estate. And we could talk a little bit about that as well. So very briefly, I didn't put together a sophisticated presentation or anything on this, but to give you an idea of what we do today and what it looks like, I'll illustrate one project that we put out earlier this year. I guess about 3 or 4 months ago. We did Boulevard, Sarasota. Are you in that one? Okay. So what we do today is we go out and find developers that have projects that are ready to go. So essentially, like we have a hotel in Denver. We had a development team in Denver approach us. We need the equity. They have the project approved. They have the construction quotes done. They may have some financing arranged with banks, but they don't have the money. So if we're going to do a project that takes, say, $40 million, they're going to need at least 12.5, 30%, $12 million, something like that to get the project off the ground. So what we do is we propose a structure to them where we're willing to come in and put the equity in, and under these, if they accept our proposal, then we package the whole product, we put it together, we create all the documents, the private placement memorandum, subscription agreements, and we put that out to our investor group, and we fund it with our current investor base, which is maybe around 2,000 potential investors, and we probably have around 300 to 400 that are actively investing with us in various deals at any given time. So we also will act as the developer on our own deals. So we'll go out and actually find a deal that makes sense, and we'll do the whole construction and development side of it, but we're moving away from that because we can only do so much of that. And it's just, we really want to be the layer over the top. And so the service I see myself providing, or our team providing to our investors, is we're really saying to our investors, look, if you want, there are plenty of platforms you can go online, or there are people out there looking for deals, and you can put your money in those individual deals. But we're providing a different layer of scrutiny over the top. We're using our experience and our knowledge and understanding to negotiate a deal that would be way better for the investor than they would otherwise get by participating directly themselves into a given deal, if that makes sense. And so we've kind of positioned ourselves as this layer. We've looked at, could we automate this, create a portal, or make it a way where we could expand this out like Fundrise or Realty Mogul or these other portals. But every time we look at it, what those portals do is they take and they put a big wall between the developer and the money. And by the money, I don't mean the bank financing. I mean the money that you guys put into deals or are looking to put into deals, the money that you had to, earn, pay tax on, and you want to protect. And the bigger curtain you put between the money and the guy doing the deal, the less you know about each other, the worse it is, in my opinion. I just think it's terrible. I think portals are an awful way to go. Almost all of them are an auction format where you're just, as a developer, to get your deal funded, you just have to make the numbers look better and better and better so that you can compete on those sites and get your project funded. And that's a bad scenario, in my opinion. When we look at a deal, we primarily look at it to try and make it look worse and worse and worse. We really work with a protection of investment philosophy. Rule number 1, don't lose money. Rule number 2, see rule number 1. That's the big Warren Buffett saying, and that's how we look at it. We're like, look, under no circumstances do I want to not be able to return somebody's money to them. So with that stuff said, I kind of wanted to get some questions if you had them, and then go from there on what I might be able to help with. Go ahead.
I'm starting from a point of total ignorance.
Okay.
Okay. Are you doing financing, or do you have fractional ownership and depreciation and all that?
So, yeah, okay, good question. All right, I'll back up. In a very simple explanation, what we're doing is we're saying, I'll give you an example. We're not doing financing. What we're doing is we're saying, okay, let's say for simple sake, somebody has a project that's going to take $10 million. We go to them, we say, all right, we'll do the $10 million. $7 million of that might be bank debt financing. $3 million of that would be investor equity. What we're doing is we're saying, okay, we're going to take that $3 million and we're going to break it up into 100 grand increments. Let's say there are 30 shares then available, right? We're going to offer those to our investors. We're going to buy some ourselves. We're usually at least a few shares. It depends on how our money's rolling out of deals, but all my money's invested in all my own deals. I really don't invest much in other stuff. So I'm buying shares, and then what happens is, let's say it's a condominium project or an apartment complex, as the property's sold, we first have to pay back that $7 million of bank debt. We then always pay back the $3 million pro rata to the investors until they're made whole. Then there's usually some type of a preferred return to the investors, anywhere from 6% to as high as 18%, that they get first as an annual return on their money. And then after that, there's a split, typically between the investors that funded those 30 shares and the development team, which would consist of my office and the people that brought me the deal in the first place. Does that make sense?
But my $100,000 investment would be a depreciable asset.
If we were taking depreciation on the deal, you would share in it on a pro rata basis. So if you think of it like you just own 1/30th of the project. So in simpler math, if we were doing $1 million and you put in 100,000, you're 10%. So you're going to see 10% of any depreciation we take against the income we generate. It's a pari passu flow through to you in a limited liability company. So yes, you get all the benefits of real estate investing. Now that's not, what I'm saying is not necessarily indicative of how other people do what I do. As a matter of fact, most of the deals we look at don't really give the investors a very fair shake at what's going to come out the back end of the deal. Some of them do. I mean, some of them really do. There are people that generate good value for people. Their deals are usually kind of harder to get into. You usually know them through a friend or a family member or a direct referral. But a lot of these things will take. You really have to read the documents because you can change it. I could say John Bogdasarian gets all the depreciation, you get all the income. You can do that. I wouldn't have 300 plus investors if I started doing that 10, 15 years ago.
John, Chip's question was, and you responded to this question on depreciation, you said, if we take depreciation.
Correct.
So I'm assuming there's more explanation there. Sometimes you don't?
Right, so on certain assets, like if you're gonna buy and hold it, yes, we depreciate it over its usable life. We'll even do what are called cost segregation analysis studies because we can depreciate the carpet over 5 years instead of, wrapping it all into the building that's 39 years. So yeah, you can get aggressive on depreciation and all that will flow through or shield your returns. But On like new construction, when we're building a hotel and then we're going to sell it, or condominiums, that's unfortunately treated mostly as ordinary income. So we encourage our investors to make those types of investments from an IRA or 401k, where the money's going to go back in there. You're not going to get whacked on taxes. Although if our returns are high enough, we don't really care. So there are some advantages to investing in real estate, in terms of depreciation and various things you can do. But to be clear, we don't really do deals based on those things, because tax law can change. Fortunately, recently it changed for the better for us. I'm not sure if I care one way or another, based on what I have to put up with to get that benefit. But it's sort of
Easy.
I just mean in the chaos of the day. I stay unpolitical. I'm not in the political world. I just don't like the fray. But so these things can change. And so, if you go all the way back to like the Tax Reform Act of '86, I think it was, or whatever, where you had all these physicians invested in these deals that really had no cash flow, but they were taking write-offs so big it made sense. Then that law changes, and people like my dad, who's an ENT doc, all of a sudden, where he was basically getting to take, a deduction every year of $25,000. Now he can't take anything, and it changes the whole thing, and his money's not worth anything because he invested in a deal that fundamentally is bad for tax purposes. So we just invest in things that are fundamentally good, and if we work the tax advantages in our favor while we can, great. But under no circumstances would I ever invest in anything for solely tax benefit. I don't care what it is. I just wouldn't do it.
So the 200 million that you have is likely kind of on the depreciable side, and the 350 that you have under construction would be to kind of sell it and take the gains.
Yes. However, it's not like you're paying income on it, before you see the money, because there is no income in the first year or two. So you are actually potentially showing a loss during the construction phase, but then you're picking that back up as you're selling units. And unfortunately, even if it takes you 3 years to build out a project, if you're selling multiple units, it's just treated as ordinary income. You don't even get a capital gains tax treatment. So you have to take that into consideration, which is why our development deals will show a 18% plus annual rate of return, whereas our buy and hold stuff might be more in that 12 to 14% range, because that's going to be a long-term cap gain when we sell those. And so we consider it when we're writing a proposal to somebody and what returns we want for tying up our money in the project, but we don't, base all our decisions based on, the current tax law.
John, wouldn't it make sense that we have a tranche of investors that have a lot of passive income and want to invest in the appreciating type of deals more so than the income generating deals, right?
Yeah, the most difficult thing I think to do in the investment world is to create passive income. Truly passive income is rare. It's not passive for us because we work on it every day, and I'm the largest owner in all my stuff, and it's like, but I gotta employ a whole bunch of people and have a team, but we management fees and stuff that offset that. But it is the most difficult thing to do, and unfortunately for us, or me especially, the entity that I created has 300 people in it, and while I'd like to theoretically own it forever, I can't really keep 300 people or 299 others or whatever it is, tied up in all this stuff. So we do have to liquidate assets, but the way I look at it from the standpoint of what I always used to say, do the work once and get paid forever, has sort of been my philosophy. And that's what we're trying to be for the investor. You found us, we make you money, we'll keep bringing deals. As we liquidate deals, you can take the money off the table, or you can just put money in the next deal and keep rolling it, and it's passive for you. It ultimately become passive for me. It's becoming more so every day. My team's taking over more and more responsibility, and so I can move into slightly more free time and things like that. But and eventually step out of the way and just be in the shoes of the investor, kind of picking and choosing stuff, which is fun. I mean, I think it's kind of cool to do. But yeah, I think no matter what you buy, what I discovered is no matter what you buy, it takes work, and nothing lasts forever. I mean, everything depreciates. It truly does. It's just more of, is it depreciating faster than inflation is sort of, backstopping it. So, I like to use single-family homes as a great example because I started out buying single-family homes. I had like 20 single-family homes before I ever took investor capital on. And what I learned was, I was buying these homes so far below replacement value. I was buying homes for 50 grand that would cost 130 to 140 to build. They were in Ypsilanti Township and, township taxes, and I could rent them all day long for $1,000, and it cost me 50 grand. So I thought, okay, that's a no-brainer. This was back in the late 90s. And I thought, well, my gosh, nobody's ever going to leave these things, or they're only going to become worth more and more and more, which they did for a while. And then, around 2006 or 7, they all went back to being worth 35. And but to me, they were always worth 60 to 75 based on the income approach to value. And since I knew that, when they went up and they were worth 100 grand in 2005, 6, I sold, a handful of them. I think I got rid of 8 before the market tanked. And then when the market tanked, I bought a bunch more for like 30. I was paying, I think, all in 30. I'd pay like 22 for the house and 8 grand to fix it up, and then we put a tenant in there for 1,000. And then once they went back up again, did I sell them last year, the year before? I think a year or two ago, I finally sold the whole portfolio because it was more of a, hey, this is a distraction. We're doing things that are so much bigger now. It's like, but if you can learn the value of something, anything, it doesn't matter. I think that's like the key to Warren Buffett. I don't know how to evaluate the value of a company. I really don't. I mean, I read financial statements. We have tenants. We get to look at all their financials. We see, hundreds of these things. We evaluate whether we think they can pay or not. But I'm not an accountant, and at the end of the day, I don't know what's going to become functionally obsolete next. We knew there wouldn't be bookstores. We stayed away from buying, Borders anchored, retail centers, and basically we've stayed away from retail altogether because we just can't figure out, what you would go to other than a restaurant, or maybe like, I cut my own hair now, so I don't even go get my hair cut. But service type businesses are all that can go in retail anymore. Anything you can buy, you just, it's one click away. So we've tried to stay away from stuff where we're trying to figure out, whether the tenant's going to be there or not. But I hope I'm answering your question. I know I've exaggerated.
No, I'm just thinking about the different
Sorry,
types of investing.
digressed.
That might have different motivations for investing. That's
Yeah.
But maybe a follow-up question would be, you're pretty diverse in what you're going after. How about new market credits, are you using tax credits or any type of funding instruments like that might help? We
did, we have a TIF, what's called tax incremental funding, on a condo project we did that was on an environmental site in Ann Arbor called Kingsley Condominiums. That's about 50 kind of higher end condos right in downtown Ann Arbor. That's been a very successful project. We got about $4 million that we recovered. If you don't know what tax incremental funding is or a TIF credit, it's kind of interesting, but it's where they take a piece of property that's bad and they say, we want it to be better. We have to incentivize someone to come in. So the parcel we had a tax, total taxes on it were maybe $20,000 a year. And when our project is all done, the total taxes on it will be, say, $500,000 a year. So the city says, well, we'll credit you for all of your, there's certain components of your construction which qualify, and they're like, we'll pay you back the difference in taxes, so call it $480,000 a year. When they start collecting those taxes, we get that back until all of these expenses associated with cleaning up the property are recovered. And so for us, it's kind of funny, is the cleanup was only like 30 grand. But what qualifies are all your parking lot, your curb cuts, and your underground work. And because we were building condominiums above parking, our whole parking qualified. So we had like $6 million in qualifiable expenses that we could recoup. So it's a bit of a goofball thing. We agreed to cap it at $4 million because the project really didn't need any to make it work. And but we, kind of negotiated that out because they have the ability to just string you along forever. So yeah, people ask. Like, I'm not really asset driven or geographically driven. I'm very deal specific and situationally driven is what I like to say. We just look for a situation where we don't feel like we can lose money and we think there's good upside for the time we're going to be involved in the project. And then the big factor is how much time and energy am I and my team going to have to put into it personally. We're always looking to try and reduce our time exposure. So we vet the person bringing us the project very, very thoroughly, just to make sure we're not going to be doing their job for them and having to fly to Nashville to go to meetings with townships and supervisors and contractors and things like that.
How many deals do you look at before you select?
We look at a lot of people before we select a person. What's happened is once we've gotten to know somebody and we've done a deal with them, we've done more and more. So I think we're on our 4th deal with a developer in Denver. We're on our 3rd, about to enter into a 4th with a woman in Nashville who's awesome. We've got one going in Sarasota and we just want to see that one go further along, but we'd probably do another one with them based on how it's going right now. But we'll wait. We kind of wait but hundreds. Hundreds come across our desk in a week. You're getting inundated with stuff. If you're in the right space, like when we were buying properties, starting in 2009, we started really aggressively buying existing assets like this one and mostly industrial buildings at the time, and no one else was buying buildings anywhere. So the minute the word gets out in the brokerage community that these guys are buying stuff, you get inundated with stuff. Well, that starts to dry up. 2015, 2016, we're switching over to multi-tenant office buildings. The deals are getting a little tighter. So, you could see it coming. And at that time in 2016, nobody was doing new development. Not anywhere around Ann Arbor for sure. And, in most cities, everywhere, there'd been no development for, 7 to 10 years, virtually anywhere, which is why we have this problem with, a lack of housing being built that's going on all over the country now. Vegas went from being the hottest market to the coldest market to now the hottest market again in a span of 10 years. And that's just how crazy people are. They go to the thing that, if you don't really understand the real estate cycle, it's not that complicated. It's a 20 to 30 year thing, and it's like a sine wave or a cosine wave, depending on when you get on and when you get off. But it's very much the same. It's just this, and it's all based on supply and demand. It's all based on supply and demand. There's almost zero quality industrial available right now anywhere that's vacant. Zero. High crane space, you can't find it anywhere. We have people, calling us like, will you build us this? Will you add on to this building? Will you do that? And so we're looking at it going, well, we bought all this industrial when it was like free and nobody else was buying it. And now what can we sell it for? And we're saying, we can get some pretty big numbers on our industrial buildings. So we've just started to kind of slowly put those out there for sale because, you want to sell when once we get into the development cycle and people start building industrial and they start moving out of older buildings into newer, fancier, more automated buildings, now we're competing, with those vacant spaces on the market. And you'll get, and the other interesting thing is when you have people starting to want to own their own assets again, which is another pendulum that swings back and forth. Do I want to own my building? Do I want to lease my building? And that's just an allocation of capital question. Can your capital be better utilized growing your business, or is it better utilized owning your building? Real estate historically will make a 10% return, and a well-run business can do 20, is what they say. I always buy that, but I think we can do 20 in real estate, and I've never made 10 on a business. So, it's just the way it is. I get it's proportionate to knowledge, but.
Are you invested in residential markets?
Let's see.
Or active in it, I should say? Are you actively investing?
We own, right now, we don't have, I just sold, in the last 2 years, I probably sold my single family. We had an apartment complex we got rid of. I don't have any residential real estate right now. I could, it's just not, I wouldn't do apartments right now. We're building condominiums, that's residential, but they're for sale product. So we're heavily invested in city infill, condominium projects.
All high end?
No, believe it or not, a $400,000 unit in Denver is affordable. And so, we're in the affordable space there, I guess, if you call that affordable. Nashville, we have a mix, but yeah, mostly we're staying into young professionals. There's a massive number of people moving into city centers again, Denver, Nashville, a lot of hot markets. And so what we just look at is what's the supply and demand in these markets? Like in Denver, there's 40,000 people a year to move there, and there aren't 40,000 units being created. So, and people are still building apartments, and sometimes apartments are the only option for people. Well, they want to move out and get in on ownership at some point. So we're kind of fitting that niche in that particular market. We're doing high end in Sarasota, Florida, because again, nothing was built there for at least 10 years. And so a lot of the people that have a, $800,000 condo on the beach, they're older now, they want to live right in downtown Sarasota where they've got access to, walkability to restaurants, art museums, activities, various things like that. So we're doing a high rise right next to the Ritz-Carlton, basically, in downtown Sarasota. It's 18 stories. It's all glass. Those are, I think, 1.6 million up to the penthouses are 7 million plus. There's only 2 penthouses, and those were like the first 2 to sell.
Pay a square foot to have that kind of building built.
Price per foot, what is that, like 800 a foot? 900? That's what we're selling them for, is 800 a foot maybe. Construction cost is probably 5 or 6. It's, that project is, so that's a good project to talk about from the standpoint of, a lot of times how you structure something is what dictates, your risk level to it. So we wouldn't just come into a guy and say, oh, you're going to put up, an 18-story building in Sarasota. Let's look at the supply demand and decide if we want to do it. This guy had half the building pre-sold with 20% non-refundable earnest money deposits. He had $4 million of his own money he was keeping in the deal that he was willing to subordinate to our $16 million. So, and there was another there's another 16 or 17 million of profit that the deal shows behind our return of capital and our preferred return of 18%. So that particular deal we negotiated, I said, look, $16 million, that's a big check for us to write. That's a big raise for us to go out with. We want an 18% return. After the bank's paid, we want our 16 million back first, then you get your 4 million back. Then we go pro rata till we hit our 18%. And then after that, he gets to keep 75% of the upside. The investors get to keep 15% of the upside, and my company gets to keep 10% of the upside. So we're literally paying our investors an 18% preferred return, and ourselves, because I think we have a share in it as well, but we're paying our investors an 18% preferred return on that project before we, see any money coming out of it on the back end. And we're just participating in the 10% of 15, 16 million coming out the back, which is good money for us for, a couple weeks work of,
In that
it's
same
no more than that.
market where you said that your costs are $500 a square, I'm just kidding, but $500 a square foot. If next door was a 10-story tall office building, what are they getting square foot for rent?
It'd be high, I think. Well, although I mean, it kind of depends on the market. If it was in Denver, it would be very high. If it's in Sarasota, not
It's
so.
high.
Oh, for office rents in Denver,
Yeah,
probably $40 a foot,
yeah, because,
triple net.
you know, I'm from Ann Arbor.
Yeah.
And I've run into that thing, you know, you can't even touch building anything because you can't get them, even with parking, you can't get up over $35 a square foot.
Yeah, so we're building on Oak Valley Drive right now by the Ice Cube. We're building 60,000 feet, and we budgeted, you know, kind of a base build out for people at $25 a foot, and we could offer the space at $19 triple net for like a build out, finished, basic office space. And what we're finding is the tenants want $70 to $80 a foot in build out, and they're willing to pay $23, $24 a foot. And when you contrast that to downtown Ann Arbor, it's a steal because we're township taxes, so your pass-throughs are going to be way less. We have parking right there, you know, 300 parking spots or something on site. It's, you know, so you don't have to pay for your parking, you don't have to pay city taxes, and so, you know, that project's gone very, very well. And I just saw the same thing you did and said, wait a minute, you know, you can't find anything downtown. By the time it's all in, you're going to be at $40 to $45 a foot. That's not even factoring in a bunch of parking spots, you know. And so we're like, well, if we can deliver a product at, you know, a 40% savings to a business, wouldn't they go to Oak Valley Drive? I mean, it's 2 minutes. It's like, you know, and so far it's working pretty well.
So what kind of projects do you have you're funding now?
Right now, we don't really have anything available. We have a development fund called PF4, which there may be a handful of shares left. They were like $100,000 a share. We took 5 development deals and we put them under one umbrella. And we said, if you want to invest across a number of deals, here's a vehicle. And so it's nice for a couple reasons. One, you get to see the reporting and get the education, I guess, on 5 deals if you're interested in that kind of thing. 2, you're diversified across deals, so if any one of them goes bad, it'll likely be made up with another one that goes good. We have some that show really, really high returns. If they all work out, you know, we projected a 15% annual rate of return to the investors, but any one of the individual deals shows 18% plus. So we kind of feel like we have a lot more upside there than we do downside, which is why we kind of did it that way. Although it is kind of complicated, and I doubt we'll do that fund type structure again with that many people. We may do a handful of kind of ultra high net worth people, and we just keep it rolling. But you need a certain type of people in that kind of deal that are truly. Over the years, I've developed relationships with a few people that, you know, can write pretty big checks, and they love what we do, and they're I don't know, I get the feeling they invest more from a standpoint of mentorship, and it's not like they don't want to make money, but they're not like calling me every day and saying, you know, how's this going or that going. They're more, you know, I think they sort of feel like they're helping us out or something. And anyway, they're very easy to work with, and so those handful of people, at some point in time, you know, my guess is I would kind of cut back to my own funds and maybe a handful of people. But more and more the way we're moving is, hey, we're doing these deals. If you want to participate alongside us, great. Get on our list. Here's a packet. We'll send it out. And, you know, if you're interested, great. If you're not, no big deal. Unsubscribe anytime you want. We don't really care. And, I mean, it's funny. The Boulevard Sarasota deal earlier this year was a big eye-opener. I was sweating raising $16 million. That was a big raise for us in any one deal. And we put it out on a Tuesday, and by the following Tuesday it was fully subscribed. And $250,000 a share. We had people taking 8 shares, you know, 10 shares. And I was like, blew my mind, because our typical share used to be $50,000. And I was like, well, if we put out $250,000, nobody's going to be able to afford to do it. And some people took half shares. We cut a few in half. But it's interesting how much, you know, an 18-story, all glass, beautiful pictures, the architecture rendering, sexy development deal. that sells. I mean, most of the stuff we raise money for are I mean, no offense, but they're buildings like this. What picture are we going to put up that's going to make this look all exciting, But they're printing money. And I'm like, so it was harder to raise money for the deals that were like consistently just, this thing's going to pay, than it is for these, the new development stuff, which is ironic to me because I always thought new development was more risky than buying something that's already sitting there where you have a lease in place and you can know what the market is. But again, you can mitigate some of the development side risk by really doing your due diligence on the market, by getting pre-sales done ahead of time, and then having an alternate exit strategy, which we like to try and have. So if we get into like a condominium project and we're in a good market, but interest rates go through the roof, or something crazy happens, somebody flies a plane into a building, and everything stops for a while, we can rent these out. We're not over levering to the point where we can't rent these things out. Maybe we get stuck in them for 5 years, 7 years, but we're not going to lose our money. And we would get, we would just hold them until the market came back. So living through a cycle or two allows you to kind of structure things in a way where, do you want to get stuck in a piece of real estate? No, but, if you do, you can see it through. I've done one deal that didn't work out in my career. Some people like to ask, well, what's the worst deal you ever did? It was actually in Grass Lake, right off the highway there. There were some lots called Vineyard Hills. I bought the remaining, 12 lots from a guy for like $250,000 maybe. And this was back in like probably 2002. And I had a builder that was going to put houses on them. I was going to subordinate the land. We were going to sell the houses off. We were going to make a bunch of money. And I had, it was $100,000 in cash that we used to do that deal, and like $150,000 in bank debt. And as we were selling the houses off and paying down the bank loan, the builder, I don't know, he got divorced, he started doing drugs, he spun out, I found another builder, replace him, we got one or two done with him, then he spun out, and and I'm not a builder, and so it just kind of, then the market tanked, and the lots were worth virtually zero for a long time, and we still owed the bank like $50,000, and the bank got nervous, so I actually wrote a check and paid off the bank. So I lost $50,000 on that, and then I was $20,000 of the $100,000 and lost that. And the investors, there were 8 investors, I think, that each put in $10,000. This is my first syndicated deal, I think, in like 2000. And it pretty much, they got some back, but it pretty much went to zero. I mean, it was virtually a complete failure. That's not where I learned the most, but it was a lesson in don't buy, rural, like things that can go to zero. I didn't realize that like a piece of land could go to zero, and it literally went to the point where you couldn't give it away. We finally got rid of the last lots just in the last couple of years, and I think they went for like $2,500. I mean, it was like, if we still had them today, they might be worth a little more, but they're functionally obsolete. There's just because construction costs have risen so much, you can literally get that land for free, but by the time you pay for the construction of a house on it, you're into it for $225,000, and that market doesn't support a house for $225,000. So it's like functional obsolescence. You just can't build in a farm field yet. You will be able to in another 3 years. It'll get that bad, and people will be like, I'm going out to Manchester, I'm going to Tecumseh, I'm going to Grass Lake. I mean, that'll happen, but we just made the mistake of, buying at the peak end of the market, and so that's the only money I've ever lost of other people's. It wasn't that painful. Nobody seemed to even care. To be honest with you, they made money on other stuff. Nobody called or anything, which was really weird. I would have been pissed, but I was pissed. I lost way more than everybody else, I guess, but because I personally guaranteed the loan. and we still do that, you know. I actually, there's recourse debt, there's non-recourse debt. That's another component of a deal to look at. I have actually written a book. It's not, it's done, but I have to proofread it before I can, and edit it once before I can tell them to, you know, finalize it. And it's been in that state for like 6 months, so I can honestly say I'm not sure it'll ever get done. But it's all about, you know, it was. I really went through the exercise because it made me put down my thoughts in writing on what someone should do. Like, what are the questions I have gotten over the years in talking to accredited investors, and what is it that they can do? How can they find people that put together solid deals? And, you know, so I put together a whole chapter on how to source deals, like just how to go find people that do what I do. You know, you can certainly search the internet. That's not my favorite. My favorite are things like this. You ask other people, hey, have you been in a deal? Do you know anybody you've been in a deal with where it's worked out? That's by far and away the best, is word of mouth. But, you know, it's hard to find. You know, I won't. You can't wait for somebody to call you, because I'll never call you. I don't have time, and I don't need to. And so if you're good at what you do, people find you. You know, so I don't have. I used to have to call people. I started with 11 investors, and I had to call them all to get them to invest, and I had to send them a packet, and I had to meet with them, and that was all. It was that way till we got to like 100 or 100 and something, and then it just kind of, you know, like now we have people investing that I've never met, don't know, haven't talked to, which is really kind of strange, but that's Will's job now, and I've been able to kind of let it go. Although it is one of my most favorite things to do, is to go through and kind of illustrate and explain a deal. I think our write-ups do a good job of it, but I really like talking about the ins and outs. My favorite is when people say, well, you know, I don't think you can get that price, or this is, you know, hey, if you thought about this or that or the next thing. And because especially in the beginning, you know, honestly, I hadn't really thought of everything. I mean, you know, you can't. And so, you know, they're good questions, and the more of them you can take, the more you can kind of shoot holes in your own deal and be like, wait, is that a concern? Is that not a concern? Does that logically make sense? Does it make sense to me to build, you know, like 5 years ago, it wouldn't have made sense to build something new because there was just too much product and there were too many people building apartments, and we had no way to backstop a deal if it didn't work out. Today, it's completely different. The lack of supply dictates that no matter what, even if we have to rent out a product because we can't sell it for the price we want, we're going to do fine. You know, and we're careful to stipulate in our documents that we're able to rent them out, and that the developer has certain rights that the owners don't, and various things like that. So, but finding people, the other thing you can do is you can go, there's all kinds of investment groups and things like that, just like this. It's great you're starting this. My favorite is you just go, like if you're in Denver, you're driving around, you get an Uber and you tour a city, you're in a hot city. You can look at like the 10 highest growth cities, and you just Google this stuff and be like, okay, Charlotte, yes. Nashville, yes. There's, you know, pockets of Dallas, yes. There's Denver, yes. Where you know you have an influx of people and companies expanding and more jobs than they have people to fill, and so people are going to keep moving there, and they need housing, and so you find that, you drive around that area and just look at all the cranes, and then on every project you'll see a sign, you know, this is being built by this guy, development team of this, that, and that. Look up the development team and just call them and say, hey, I was driving by your project on, you know, Elliott, and I think it's a beautiful project. I'm wondering, do you ever take on investors? You know, it's that simple, and because they're all looking for money. I mean, everybody's looking for money. Everybody in Denver is starved for equity, which allows us to come in. Like if I go to Denver and I line up deals to look at, I literally will fly in on a Wednesday morning, leave on a Thursday afternoon, and have had 12 appointments with 12 different developers, with 12 different projects that are teed up and ready to go, and they all need our money. So I can just say, you know, these 6, definitely not. You know, these 3, I like the projects, I didn't like the guy. You know, these 3, I like the projects, I like the people, these are good. This one definitely stands out. Let's start with that one. And we'll write a proposal to them and we can say, hey, we want this, this, and this, and that, which is usually rather egregious and, in a way. I mean, it's market, I guess, so it's whatever you negotiate. But so this is what we can sell to our investors. That's what I always tell them. I got to sell it to my investors. Well, it's interesting to have that third party thing, on the back. I've got to be accountable to my investors. We have auditors. We have to have, all books, records, background checks. I need your social security numbers. It's got to be pants down. And they're all like, absolutely. They have no other place to go. So, and then once you get the reputation in that market for writing a proposal and then doing it, then you get called all the time. And to me, it's far more powerful to aggregate, a mass number of accredited investors as opposed to trying to do the whole deal and keep it all to myself. It's just been far more powerful for a number of reasons. The first one is I don't have the financial capacity to backstop, a $40 million deal. Maybe one of them, but that would take everything I have, and I'd be begging for mercy if the bank called the note. I'd have nowhere to go to get that money. If I do a $40 million deal today and I put, $12 million down and I borrow, $28 million from the bank on a construction loan and we get into trouble, but it's still a solid project. It's just we had some cost overruns or we have whatever. We've actually, I don't think, ever made a capital call, but if we did have to, I know I'd get backing and I could easily have everybody put up 50 cents on the dollar and put another $6 million down to satisfy the
Never
bank.
made a capital call?
No. In the case of the vineyard lots, I would have liked to have made a capital call to pay off the bank debt, but at the time, I felt it was my error and I accepted responsibility for it and I just paid it off myself. But no, I've not. We have created mezzanine private loans, mezzanine loans. So, for instance, on the hotel in Denver, we thought we needed $10 million to do that deal based on the bank quote. Kind of at the 11th hour, the bank reduced the amount of the loan they would give us. They said, we ran into some ceilings I was unaware of. We took this to committee and we can't give you 30 million, we only give you 27, or whatever the number was. We were, I think, 3.1 million short. And so instead of, we already raised the 10 million. Instead of calling everybody and asking them to put another 3.1 million in, we just created basically a private loan, and it sort of had this similar economics, and it's like we borrowed the same amount from the bank, but we just did this much from the bank and this much from private individuals. And these members that put the 10 million in had the first opportunity to take any of that they wanted. But we've never had like a capital call or a forced thing. We just were deciding, do we want to do this deal and does it make sense? And actually, because the developers on the ground represented the loan that they were going to get to us in the first place, it allowed me to go in and retrade them on the deal and make it far more lucrative to all of us on our side anyway. So we turned it into a pretty good advantage, I would think. But yeah, no, we haven't.
Now you create a separate LLC for each one of these deals?
Each individual property or development deal sits in its own LLC. In some circumstances, like with our portfolio of existing assets, we maybe have 30 properties. They're all in their individual LLCs. Those are disregarded for tax purposes because the investors are really invested in a parent company called PF3, which is the 100% owner of all these sub-entities. So for liability reasons, and because if one deal went bad, we don't want the lender to be able to crawl through and get to the parent company, we can chop that one off if it goes bad. So for liability reasons, we keep them in their own separate LLCs, but sometimes we pool the investment dollars into a parent company. More and more so, though, we're going to each one sits by itself, just because.
It's convenient for the investor because because then I don't have to have a separate LLC.
Right, well, you never have to have a separate LLC. That would be a kind of a ridiculous redundancy. The only time we see that is if where it's like an investment group and 5 people are together and they've each put, $1 million or $500,000 or 150 grand into whatever it is. They've each put in a certain amount into this LLC, and now that LLC is making investments, into various things. We've seen that. Usually what ends up happening is those eventually get dissolved and we take each individual's ownership and put it in their own name. That's happened. Actually, I think that's, I think a number of the Michigan Heart guys did that originally. They invested with us, and then they were in a group or something, and then we dissolved that. Now they own their own interest.
Do you do any of these, I don't know what they're called, my one son told me about them, where, you might buy property on 3 out of 4 corners on an intersection, and you do hotels, and you basically develop it and own the hotels, but the hotel company operates. What are those? It's like an REIT for hotels or something, huh?
Yeah, so the hotel world, hospitality is a very challenging thing to get financed. It's hard to get a reputable flag approved, like Marriott won't, really award you their brand very easily. You have to have, a certain amount of, we kind of got lucky on ours in Denver because we got in under the Westin brand, which was a Starwood brand. And then of course Starwood and Marriott really took over Starwood. And so now we're a Marriott flag, which is great because their booking platform really creates some benefits to you in terms of you go to instant market occupancy the day you open because nobody really cares how old a hotel is. They just look at the reviews and the availability and the room rate. So really the day you open, if the market is 80% occupied, you're going to be 80% occupied, which is the benefit, I think, to those platforms. And then that allows you to sell your building very quickly. And most people that do hotel development build them and then sell them to a larger fish, which is like a real estate investment trust, REIT that owns, like Apple REIT is a great one. They own, I don't know how many thousands of hotels or whatever, but if you want to invest in hospitality, I'd look at REITs as a way to do that. If you want to invest in residential, Sam Zell was brilliant at creating REITs. Equity residential was always a really good investment for me. It's thousands and thousands, tens of thousands of apartment units, diverse across the country. Manufactured home communities, MHC, I don't know if they changed the name of it or not. Yeah, that was a Zell vehicle. Yeah, and now it's like Equity Lifestyles or something. Yeah, they changed the name. Manufactured home communities didn't sound so good, I guess. But the thing about REITs and investing right now for passive income, which we talked about as being probably the most difficult thing to do, it's really a terrible time to get into it because if you want any kind of liquidity whatsoever, like if you look at real estate investment trusts, they're kind of like a bond. So they have a yield and their share price trades and they're inverse to one another. So like Equity Residential right now, I looked at the other day and its yield is only like 3-point-something%. Okay, so you can put 100 grand in there and you can be right for 5 years in a row and make your 3-4% on your yield. But then when that yield goes to 6%, your 100 grand becomes worth $50,000 like virtually overnight. And so you've lost 50%, in a second. And if you think you have the ability to gauge that and get out at the right time, you're wrong. It's not possible. Nobody can time the market. We're intuitively built to do it backwards. And it's just, I don't know anybody who can do it right. I mean, I really don't. I think if they do it right, cryptocurrencies, it's just guessing. Everybody thought they knew everything. Oh, cryptocurrencies, and my friends were getting into it. I have people that bought $1 million homes because they were doing so well with it, and now it's, pennies on the dollar. I mean,
have you seen anybody build industrial spec places?
We are about to embark on a journey to do that in Nashville, actually. Their market is so tight.
Industrial buildings?
Yeah.
To spec.
Yeah.
Spec building.
But that market is so tight and the lease rates are so high on industrial. we're not going big. We're doing buildings that can be broken up into smaller units if we want.
Multiple occupants.
Yeah. So we're doing kind of like, it's really like a flexi industrial. It could be, we have options. We could kind of morph it into more of a techie, tech center type thing if we wanted. But I'm actually supposed to go down there in the next few weeks to really, the numbers on paper on that deal are staggering. It's just a question of, I got to go down there and look at it and touch it and feel it. Anytime we're doing something brand new, but it's getting there.
But it's almost impossible to build new right now.
Yeah.
Factory space.
It's a real problem.
You can't build it you can't rent it for anything close.
I think if you really look at all the moves that are being made right now from a political standpoint, to me, it all is leading towards a pretty heavy dose of inflation coming down the pipeline here very quickly. And it'll, I think, happen faster than we realize. That's my belief. If I had a crystal ball and I knew how to place the bets, I would have shorted the CMBS market in 2007. I knew it was going down. I just didn't know how to make that bet. I don't know how to trade options. I don't know how to make those. All I can do is take advantage of what I know and saw, which in 2007 was sell everything we can get out of and just wait. We didn't do anything in 2008, nothing. And then when it came time to buy, we bought in 2009. We have some deals we did that if I was smarter, I'll give you a great example. Applebee's. That's probably the best example I have. DineEquities. We tried to buy 20 Applebee's restaurants scattered throughout Michigan in like 2010, I think it was. And
Hey, John,
yep.
Can you, when you say buy that, you're trying to buy the land?
We're buying the real
and have a
estate,
triple
not
net
the
lease?
operating business, yeah. They had 20-year leases in place, guaranteed by DineEquities, the parent company. And nobody wanted to buy them because DineEquities was up against like a debt covenant coming due, and everybody was afraid that fast casual or whatever it was called was going completely out of business. And so, but these restaurants that we had were all profitable at the store level. And so we didn't really care. We were like, we just want to own these real estates. They're great locations in good markets that are very resistant to any kind of downturn. We couldn't get anybody to loan us the money to do the deal. Nobody. I had plenty of investors. I just didn't have any banks that would finance the deals. So we ended up buying two of them. We got one done in Big Rapids and one in Ludington because those markets, the banks would loan in those markets because those banks didn't have any downturn. There was nothing for them to loan on in the upswing, so they didn't have any bad loans in the downturn. So they were just salivating over themselves to loan to us on these, and they all ate there every day for lunch. So honestly, they were like, I eat there every day. We'll do that loan, and so we got these two Applebee's bought, and I didn't really, at the time, DineEquities was trading at $5 a share, and I remember like a year and a half later, maybe 2 years, we sold the equity. We sold the two Applebee's that we owned because we didn't get the other 18, and it wasn't enough, and we were also getting worried about restaurant, and cap rates had compressed. So when we sold them, we doubled our money. It took 2 years. We doubled our money on that deal. It was a tremendous return. I thought, I'm so smart. I'm just a genius. And I can't remember who it was that printed something out for me and handed it to me and showed me that the day we bought those two buildings, DineEquities was trading at $5 a share, and the day we sold them, it was $24. And so I could have gotten almost 5 times my money had I just bought the damn stock, But I can't raise money from investors to buy stock because they would look at me cross-eyed and be like, what you're talking about, and frankly, they'd be right. But it is, if you know how to make the bets and you're financially savvy, there's an infinite number of ways to make money. I just know real estate and try and play it slow.
So what would be, well, let's say somebody signs up for your email list, and what would be like in the next 6 months or a year, something they might see?
So I hope to have at least one more deal out this fall. We really only do like maybe one a quarter. That seems to be about our pace right now. Primarily because we're just we have too much going on, and so we're trying to be ultra selective until we start unwinding some of the PF3 stuff that's taken a lot of our time and energy management-wise.
What's your constraint, people?
Yeah, and also people management. I mean, look, I'm a terrible business owner, operator. I'm absent, 75% of the time. I hyper focus, so I can get up here and talk, and I can be dialed in, and I can be paying attention. But then, half the time I'm just a scatterbrain, and I can't stand anything that's not like a truly kind of intense situation. So I work for maybe 2 hours a day, and it'll be, it's I think it's intense to me. I'm hyper focused. I'm dialed in. I get it off my plate, and then, it's not like I'm not working the rest of the time. I'm thinking about stuff. I'm reading things. I'm sort of, putting questions in my head of what I might or might not do with something, and sort of waiting for the answer to arrive. But I'm not good at running an office.
I interrupted you. You were about ready to explain your next.
Yeah. So that what constrains us is, I think, all of our lack of wanting to. Everybody I have in my office takes care of themselves. We don't have a clock. We don't, have a vacation center.
Is this part of your team?
This is part of my team here. Will handles all investor relations now. Anthony runs a lot of developments and head of leasing for all our existing stuff. We just brought on this McClellan kid. He's the little brother of another McClellan kid who's my CFO who couldn't be here tonight. So we got McClellan and McClellan. And Brad is director of operations and really runs the day-to-day office, and he can't stand it either. So he's like, let's not hire anybody else. Let's just work with who we have. And then Lisa's handles all kind of PR, marketing, output. Somehow got me accepted into this Forbes Real Estate Council. I didn't have anything to do with that, but it should,
worked.
yeah, but it should be fun. And then we've got other administrative assistants as well, but it's a relatively small group. And then we have outside property managers, like Anthony oversees some building engineers, some on-site property managers for some of our more tenant-heavy properties. And then we have, every development has its own development team. So, there's a hotel team on the hotel in Denver, then there's a condo team, different developer group on the condos in Denver, then there's the Nashville and another one in Sarasota, but they're not direct employees for us. And that's just a better setup for me. Like, hey, police yourself. If everything's working fine, great. If there's a problem, I'm really good at getting in and, solving that issue. So what you would likely see from us is, I don't even know if we send a monthly thing. It's more like, we probably have like a quarterly deal that goes out and says, hey, here's a summary. If you're interested, by all means, give a call. We'll get you any and all investment. When someone initially signs up, we have a packet that goes out that explains a lot about our company, how we work. We could send samples of any and all deals we've ever done. We operate with 100% transparency, so we've had people ask for some kooky stuff, and we just fire it to them. We don't really care, as long as it's not a EIN number or another investor's information. If people want references, I've got, pretty much, I don't have anybody that says, hey, don't share my info, but I try and be, somewhat selective on providing references. I don't want people to bother people all day long, but some people are a little more skeptical investors than others. David? No, I'm just kidding. Which is good. I actually enjoy that. Yes.
John, do you have some sort of matrix that you look at for reviewing deals, and is there a threshold that you have to be at before you'll do one?
Like what would our parameters be? Or
Yeah, what would so just for example, as a grocery store within walking distance, the growth of the area, all that, you mentioned a few of them, but do you have a systematic tool that you use to make these deals?
Yeah, so we have like due diligence checklists, things that we would typically go through, but it's kind of become internalized and it's more common sense now than anything, but it all flows the same way. You start macro and you go to micro. So you go from, is this city growing or is it dying? What's the job situation? You evaluate the city. Then you'll narrow it down to that particular area in the city. Then you'll narrow it down to, maybe that block or that street. Then you'll look at, that particular product type. Are we talking condominiums? Are we talking retail? Are we talking whatever? Then we just start looking at how do we lay off any and all risk to a deal. We don't want any risk. So how much of it can be pre-sold before our money goes in? How much of it can be, quantified and dealt with, again, before we, our dollars get to be at risk. And we even go down to, the person bringing us the deal, the person who owns the land, what's their connection to the people who brought us the deal? Are there any kind of goofy kickbacks coming on this deal? So and you're doing background checks, and I mean, anytime I'm not paranoid enough is when, we get into something where, we really should have looked at this or looked at that a little more carefully. And, it's just live and learn type stuff. But after, a number of years, you've made pretty much most of the mistakes I think you're going to make. It'd be really weird to me to basically do a deal anymore that would really, be bad. I mean, I hate to say that, and this isn't wood or anything, and I'd knock on something, but it's sort of, with the absence of being able to, nobody controls a market, so absent market risk, we're not likely going to miss much on a deal. And that just, I think, comes with having done enough of them.
Well, let's stop the kind of this formal time now, and anybody who wants to hang out and meet John or the team, you can probably be around for a little bit. And
yeah, I hang out for 10, 15 minutes. I'll start shaking if I don't have a drink before about, So.
We again, we have a sign-up sheet. If you want to sign up to get on the Promanas, email list, or if you want to talk to the guys directly, but just thank you very, very much for sharing with us tonight.
I appreciate you having me, and I know everybody's busy these days, so taking your time to come out. I hope there's something I said that's useful to you in some way, shape, or form. It's kind of funny, once you get to know something, you kind of feel like, well, everybody knows that, don't they? And so I don't know, if there's anything I do or say that makes any sense or resonates, but hopefully something does and was worth your time.
I think, so we're an investor with you, and I don't think I appreciated at all the factors of the leverage that seems like Promanas is able to implement as far as reducing the risk and improving the equity investors' kind of returns. It was really interesting to learn that.
Yeah, it's weird. It feels at times, it always feels really risky to us because it's other people's money. And
Sure.
It's the background, that's another thing. If you're considering investing with someone, there's a list of questions that I put together, and I'll email you some of this stuff if I can dig it up. But really trying to understand someone's background and mindset and where they came from, I think is really important. My dad was a poor doctor, works for a living, 50, 60 hours a week, and ear, nose, and throat, and old school doc. So, you went in with a sore throat. He didn't tell you, oh, you need your tonsils out because he could make more money on surgery. He'd say, hey, let's try antibiotics, and, you don't need your tonsils out. And he was that kind of guy. I was like, Dad, just take their tonsils out, pay for school. No, I'm just kidding. But so, watching that, it's interesting because when I invest, I try not to invest my own money in other people's stuff anymore because I am not very good at scrutinizing the deal. It's not my mindset. I'll just be, oh, you got a deal here, here's $100,000 or something. And they don't seem to work out very well. Because I'm not good at scrutinizing it when it's other people. But if I have other people's money, then I become wildly paranoid about something going wrong. Because I know that for my dad or other physicians or most people in the world, to save $100,000 means they had to, make $400,000, pay tax, pay their bills, and and you got 100. I mean, it can be years to put that kind of money aside to go in a deal for a lot of people. Most of my investors, I would say, are not, ultra high net worth people. They're what I call the poor rich people. And so, at least that's how I like to think of it, is like, for us, if we're, like, I just now have started to say I'm only putting my money in the deals I do where I've got, myself and my investors, because I don't even think of my own money as being in the deal. I just think of their money as being in the deal, and I can't lose that. So, thank you.
All right, well, thanks a lot.
Yeah, appreciate it. Thanks.